Welcome to the Commercial Real Estate Mentorship Program. The key ratios to a successful commercial real estate purchase. The ratios are critical to your understanding of the valuation and the operation of a business. And when you're trying to make a business decision, the intelligent, informed business decision, you better have all of the financial information so you can calculate the numbers. I'm going to go through them step by step. We're going to talk about a number of things, and I'll go through them logically. NOI, net operating income, is the cash flow from operations from the business. It is only the income that you actually receive minus the actual operating expenses of the business, and that is it. Nothing more, nothing less. It shows you the cash flow of the business from operations. It does not include debt service. It does not include income tax. It is simply the cash flow in from income and the outgo for the actual business operations. Capitalization rate is a way to determine a value for a property, but we're going to do that from a foundation of knowing the NOI first. Cap rates, when applied to the NOI, will give you an appropriate valuation for the property. This is just, we're going skimming real quick. I want to tell you what I'm going to talk about, then I'll go to the deep dive in a minute or two. The before-tax cash flow springboards from the NOI. The vacancy rate, what percentage of the building is vacant, or how many of the units are vacant as a percentage of the total. Gross rent multiplier, GRM, is the price divided by the rents that equal the gross rent multiplier. That's pretty straightforward. We'll talk about that in depth in a minute. How you're going to work with these numbers, it will help you make that intelligent, informed business decisions you need to make in your life. You need to get the good data. You need to have the data, and we're going to talk about how you get that data. But right now, I need you to understand what they are in some depth. So let's take a deeper dive. NOI is the income from the property, the actual income, not the scheduled income, but the actual income they receive, net of vacancies and collection loss, minus the actual operating expenses for the building equals the NOI, the net operating income. So let's do an example. If the scheduled income for this building is we have $500 per unit times 10 units. Now, I'm using the houses just as a metaphor because we're talking about maybe apartment units or office units. So let's just use this as a nice metaphor for what we're talking about. We take the actual income, this is the scheduled income, and it would be 10 times 500 or 5,000. But the actual income shows a vacancy. So we're only having $4,500. So if these was 10 apartment buildings leased at $500 a piece, or 10 retail stores, small little retail stores, we would have a $4,500 actual income, not the scheduled income. Now, if we have a collection loss and someone's not paying, that would also be deducted. So we'd only have real income, actual income of $4,000 a month. That is what we're going to use as the starting point for calculating our expenses. The actual income, not the scheduled income, not the pro forma income. Many times when a listing agent or a seller has something that they're not really proud of, maybe they're going to give you an assumption, a guesstimate, a pro forma. And that's not the real number. That's just the highest believable or unbelievable number they've dreamt up with no reality facing it in terms of vacancies. There are 4 broad operating costs and expenses in the operating expense category. There's property taxes. Now, this is real estate property taxes, and if you have an apartment building, you may have some personal property taxes, where they actually tax things like the refrigerator, the stove, a dishwasher, separately as personal property. And you're going to pay the property tax bill, so it's property taxes, both real and personal. The second thing is insurance. That insurance should cover your property damage and your liability, because if someone slips and falls, you better be insured. We're the most litigious society in the world. So if someone slips and falls, you will be sued. Having insurance policy protects you for that, and also for damage, weather, or something that happens to the property. Someone runs into the building, or a tree falls down, or something like that. All of those things are covered by your insurance. Repairs and maintenance covers a boatload of things. Many times people will try and maybe lean into this a little bit by saying, well, we don't have that much in the way of repairs and maintenance because it's a very easy building to maintain. I think Cuba Gooding said, show me the money. From my perspective, it's show me the numbers, show me the books. Because repairs and maintenance should be in the 20 to 30% range based on the actual income. If they show you numbers other than that, I'd have to have serious questions. Now, that's an apartment building. An office building would be less than that. But the repairs and maintenance from things that have to be done, the things you have to do for tenant improvements and all those things will probably go to capital expenses, but many times they're bundled in here as well. Property management. Here's something which is very interesting. You will find a disproportionate number of listings by sellers actually listing their property for sale or brokers, agents. Many times they will, for whatever reason, not include property management as an expense. Perhaps it's because the owner doesn't have it because he does it himself, or perhaps they're making the underlying assumption that you're going to manage the property yourself, and it actually makes the numbers look better when you take off 10+%. Why would it say 10 plus? Here's why. Property management could go as low as 8% in some jurisdictions, but I think 10 is a realistic number to plug in for you. That's 10% of the actual receipts monthly. But as an important caveat for you, you have to understand, property management companies charge you for leasing up the property, for renting the property, because they can and they will. Secondly, as an additional surcharge, they're going to charge you if they do repairs and maintenance. Well, they may not do it, but they're going to hire someone, so they may charge you 10 to 15% as a surcharge on top of the general contractor or the subcontractor they hired to do the work. Property management is one of the things that you need to make sure is in there and you factor in there. And also make sure all those expenses are realistic. And we'll talk more about that when we go over how to find the numbers. But you understand those that are for major expenses. And those utilities would be included inside the property if you're paying them. And obviously, if you're being reimbursed for them, they wouldn't be included as an operating expense if you're getting reimbursed in an office building where they're paying the triple net leases and so forth. To recap, actual income, not the scheduled, minus the actual operating expenses equals NOI. Why is NOI so important? Because it is the foundational number to find out what this property makes. Your lender is going to look at that number, and here's an important point for you. I want you to understand, and this early on in the program, but when you're buying a commercial piece of property, you're not the primary source of repayment, NOT. The building is. They're going to look very critically at the NOI and determine that they want to make a loan because they believe, and it's proven, that this building's net operating income can sustain the building, pay the expenses, and pay them. And they'll probably want a bit of a cushion on there. We'll talk about it in loan underwriting. But the bottom line is that they're going to look so critically at NOI, they want to know the number is real. And the good news is the NOI stands in front of you, and you're not the primary source of repayment. You're a secondary or tertiary source of repayment. The building is the source. So you could be someone who doesn't have absolutely perfect credit, but if you've got a great building, you're going to be able to get the deal done. That's important. That's how important NOI is. Now, watch out for those real expenses versus the rhetoric. And I've gone over that. Property taxes are pretty straightforward. Insurance should be pretty straightforward. But the two places I help critically are the repairs and maintenance. Are they realistic numbers? And can you get to the truth, the proof? And lastly, did they include the property management? And did they put a realistic assumption if they didn't? 10 to 15%. Watch out. Make sure you get the line-by-line expenses. Do not take, well, operating expenses are X. No, you want to see what those numbers are. You want those things broken down line by line, which means property tax so many dollars, income so many dollars, repairs, maintenance so many dollars, and the property management so many dollars. They're spelled out. And if you get a bunch of numbers at all, a bunch of zeros at the end, they probably aren't the real number. Chances of that are very, very slim. If the numbers are the truth and they have the proof, you're going to see numbers which aren't all fives or zeros at the end. Watch out, you can get the actual income information. And here's a watchword for you. Even if your building has 100% occupancy, the lender will never necessarily take that into their analysis calculations, because a lender is going to look at the actual income of the property and compare it to the actual vacancy in the area. Even if you're 0, if the actual vacancy in the local area is 6 or 7, they're going to take 6 or 7% off your actual income in their underwriting standards. So you better make sure that your numbers are real and you have them, and they're not a pro forma, just like I described, or scheduled. Watch out for mathematical errors. It is astounding to me that someone, and the big major firms like CBRE or Cushman & Wakefield, highly improbable that somebody's going to catch a mathematical error. And the mathematical errors could be simple subtraction. They could be that they're not even consistent in what they said the cap rate is from the beginning of their presentation to the end. Or the math on NOI is not accurate. The math on the division on the cap rate isn't even correct because they didn't do it right. When operating expenses come in, watch out that all the bills are paid. One of the tricks that can be done is they've held off paying the bills, which are accounts payable, to make the net income look better because they've got expenses they haven't paid yet. You need to know that all the bills are paid, because what if they left off a $10,000 bill off of the property? Would that reduce your expenses? Yeah. I mean, I'm not trying to scare you off. I'm trying to just give you a heads up. Street smarts. I've been doing this for decades, and I know what people do. Sometimes it's just a mistake. Sometimes it's a sleight of hand. Double check. Are the numbers realistic? Do they make sense? Are all the numbers documented and accounted for? Or is something left off? You need to know that. I'm taking a ton of time on NOI because it is the foundation of everything. The next is cap rate. But cap rate, you're going to be using the NOI, and it's the way you can determine your realistic return on your investment. There are multiple cap rates we can come up with. We can have a cap rate predicated on what they say it is and a pro forma income, and we can have a cap rate based on your offer price versus the actual number, and we're going to go through that step by step. Now, the cap rate, people often ask me, how high should the cap rate be? Well, the cap rate should be 2% higher, in my opinion, than the interest rate on your loans or your debt service. So if your cost of funds is 3.5 on your apartment building, let's say 4, then your cap rate ought to be at least 6 to make it make any sense. Is you don't have a spread over the cost of funds, your interest rate, expressed as an interest, you're going to be hurting if you have any difficulties. And you at least want to get that kind of return on your money and a spread on it. So 2% higher than the interest rate in your loans. And as interest rates go up, as they may have, or they did previously, I still keep it 2% above whatever interest rate I'm currently having to deal with. NOI divided by price is the cap rate. Now, the NOI could be the pro forma NOI. It could be the actual NOI. It could be anything. It could be your price, their listing price, or the final negotiated price. So your cap rates could fluctuate based on your numbers you're using. If you start off with what they're offering, their NOI based on their numbers and their price, that's one thing. But when you go on forward and you say that, hey, the net operating income isn't quite there, you left off the property management, so therefore it's overstated by 10%. And I'm not willing to pay your $1 million price. I'm willing to pay $900,000. That will change and adjust your cap rate. And those adjustments will help you make an intelligent, informed business decision. I'm going to do a couple of examples. And I don't like the examples where people use $1 million properties and 10% because that confuses people. It is a division problem, not a multiplication problem. You take the income and divide it by the price. In this case, the net operating income that we're given is $100,000. The asking price in this property, or whatever price, is $800,000. Therefore, it's a 12.5%, 1.25 decimal, or a 12.5 cap rate. When you do the division, you're going to end up with a number. If you express it as a percent, all you do is take the percent sign away, plug in the word cap rate, and you've got it. It's mumbo jumbo. Sometimes I think people do these to be just throw you off or get you off guard. It's simply a division problem. It ends up with a percent. Take out the percent sign, put in cap rate. What if they wanted $900,000 and you wanted them to pay $800,000? We plugged in their $900,000 asking price. That dropped the cap rate down to 11.1%. Because the division is 900,000 into 100,000 equal 0.111 or 11.1%. Take off the percent sign and call it a cap rate. You can see we've seen two cap rates for the same property. You could have more than one, and the one you're worried about is what you're going to get it for. Now, what they're offering for is a starting point. That doesn't mean that that's what you're going to pay for it, because I don't believe in paying retail. And so let's try and do that to get a better deal. Now, if you do that, maybe 100% of your offers don't get accepted. But if 100% of the time you know you're going to make money and you've made an intelligent, informed business decision, I'm okay with that. If you don't ask, you don't get. And that's the truth. And I have the proof here. Now, in this case, if we had $800,000 as my offering price, and it only has a $80,000 income, the cap rate dropped to 10. We dropped our price to $800,000, but we found out the truth was that was a pro forma income, so we have a third cap rate for the same property, 10% in this case, which is respectable. It certainly is. The cap rate, as a reminder, should be 2% higher than the interest rate on your loans. And that if interest rates go up or you have a higher interest rate, if you have a 5 or 6%, maybe you need a 7 or 8% cap rate. That's the way it works. Now, before tax cash flow, BTCF, takes the NOI, the net operating income, the real net operating income, and deducts your proposed debt service or your actual debt service. And that will give you the before tax cash flow. Before tax cash flow, in the example we had just a minute ago, we had $100,000 of income minus $60,000 of debt service equal $40,000 in terms of the before tax cash flow, but after debt service. Now, it also lends it to giving us an issue on what we're going to make on our money. If we take the before tax cash flow and divide it by the down payment, we're going to get the cash ROI. Cash ROI is nothing more or less than taking, let's say we have a $40,000 income, and we divide it by our down payment of $200,000. That equals we have a 20% ROI. We're making $40,000 on our $200,000 purchase. 20% ROI. Vacancy rate. It's the total number of units that are vacant divided by the total number of units. It could be the total number of square feet that are empty divided by the total number of square feet, like I showed you on the opening slide. If we had an office building, we wouldn't do it by number of units because they aren't all equal in size. We're going to do it by percentage of the square feet, which is occupied. In this case, vacant. So if you have a 100,000 square foot building and 10,000 square feet are vacant, you have a 10% vacancy. If you have 10 units and 2 are empty, you have a 20% vacancy. If you have 1 vacant out of 10, we have a 10% vacancy. We have 1 out of 100, we have a 1% vacancy. Make sense? Yes, it does. We just spread the risk. If we have 1 out of 20, you have a 5% vacancy rate. It's pretty straightforward. Now, we're showing houses there, but that could be office building units or retail stores or whatever. It's just the ratio. You need to find out the actual vacancy rate, what it currently is, and what it has been in the past. So you need 2. 1, what it is and what it's been in the past. And actually, there's a third thing you need to know because the lender is going to know it. What's the vacancy rate in the area? Because whatever your vacancy rate is, juxtaposed to against the vacancy rate in the area, they're going to choose the larger of the 2 vacancy rates to determine what percentage of your income they're going to actually use in their calculations on NOI. Gross rent multiplier. This is the price divided by the rents equal the gross rent multiplier. Pretty straightforward. But I do have a bit of a problem with this because too many people who have got a property where the operating expenses may be out of whack, they try and push this forward and just talk about to balance out the price versus the rents and how many times rent you're going to be paying for the property. It's overused. It's not as accurate as I want. It doesn't take into account any of the expenses. So those are my 2 watchwords. Get the real operating numbers because they may not be reflecting. If you get a cap rate, You want to make an informed, intelligent business decision based on the rest of the data. You need to do it step by step, line by line. Fall in love with the numbers. Don't fall in love with the property. If you find two properties and they're similar in the numbers and you like one better than the other, then certainly go with that one. Or if you can, do both. That's your choice. I'm not pushing you not to do a building. I'm pushing you to make an intelligent, informed business decision always. You can use the numbers and put it all together. I want you to check out the download. There's a free download in there where I've actually worked out and we've come up with software. When you plug in the numbers for NOI, it flows all the way across all of the ratio data, and you can use it to come up with your numbers. Now, you still got to do your homework, but it just helps you make a cross-check. This is what it's all about, helping you become an informed, intelligent commercial real estate investor. Take care.